Today, I think that you just got to pick your spots better. You know how like LeBron James at this age, he doesn't shoot every shot that he used to take. He'll just make the extra pass. And I feel like being in these rooms help you with your experience, family.
Hi, everyone. Welcome to another episode of our webinar. I'm Dr. Fasanya. I'm a real asset investor. My co-host, Dr. Ozoude, is an orthopedic surgeon. He also does real asset syndication. And we have with us Josh Harmon, who is also a real asset syndicator and real estate broker. So he has been in this market for a long time. And when I talk to him, he's, he's very knowledgeable with in the state of the market, what's going on, what should you be doing right now. And I think some of our conversation, it's important that everyone also be aware of how to position yourself. So I'm going to give it to Josh, and we're just going to make it very interactive. And so, yeah.
Appreciate it, Bio. First, I want to thank Dr. Ozoude, Dr. Fasanya for having me. It's always an honor to be in the same room with guys that are operating at a high level, have accomplished a lot of things, and I really appreciate that. And everybody who watches it, thanks for your time. It's a humbling experience. Well, Bio said, my name is Joshua Harmon, real estate broker in the Fort Smith, Arkansas, which is Western Arkansas. We also serve Northwest Arkansas and Eastern Oklahoma. We do anywhere between 50, right around 50 million a year in volume. When we're locked in, we got to go over 2026 at Harmon Real Estate Company, my brokerage. We focus in multifamily, and we've geared up our team for 2026. So we are on a goal for 150 million in 2026. I also operate Belle Point Capital, which we are, like he said, syndicator. We raise money from investors. We also deploy our own capital, just over 500 units. Honestly, today we got a few that we're selling just to keep that capital rolling and to capitalize some deals we've owned for a minute. We have a lot of equity in. We got a lot of big things coming in 2026, deals coming. And so, yeah, awesome to be here. But we were talking a little bit before we came on about just different valuations for properties and the sentiment in the market right now. And just depending where you sit, your perspective may be a little bit different, but that's why we get on these calls and share our ideas, give feedback about what we're seeing and what we're hearing from our different walks of life and our different positions in the capital stack and things of that nature. This opportunity is not just for us to communicate with each other, but also for you guys to hear about what we're seeing, get feedback from us and all our different perspectives, and try to use that in your day-to-day decisions when you're in the market. But we're not financial advisors or anything of the sort. We can't give you any investment advice, but we think that you can pick up some things from us that may be helpful with your investment decisions. George, pass the mic to you.
Yeah, thanks for coming on tonight. I think we should just jump into some Q&A. Like I was saying earlier, this was a pretty important day. I'm glad the webinar is happening right after a Fed rate cut. I think a good question is, what do you think that means for the overall markets? What does that mean for multifamily going forward? I know I hear a lot of different things about what rate cuts mean for real estate, for bank lending. So it can go either way, honestly, depending on how you take other factors into it. So what's your take on what the rate cut means today? We have another 0.25% rate cut, 0.75% rate cuts total for the year now.
It's helpful. It makes the cost of capital just a little bit cheaper. And that's a challenge for everybody. So I sat down last week with a pretty big fund manager about a different topic. Of course, it wasn't anything about rate cuts or anything like that, but I always try to get some information from people who are deploying a lot of capital. And they got a couple of $50 million funds. It wasn't the first time they've done it. And they didn't have a lot of transaction volume this year. They said that we're looking at a lot of deals, but we're passing on the okay deal, right? If it's a good deal and it just makes their minimum returns, they're passing on that, right? And this is somebody with $50 million sitting in an escrow account that they can go deploy. and they're passing on those okay deals because they feel that better opportunities are ahead for them. So that's something when you reduce the cost of capital, it makes it a little bit easier to make those decisions. It makes it easier for deals to pencil. And for those who don't know, community banks lend on that Fed funds rate, right? The lower that rate gets, the lower the even community bank debt gets as well, not just the institutional players. This benefits everybody. So I think it's a good thing. I think they can be a more aggressive with it, but obviously the fear, like you guys know, the fear is you reduce rates too low too quickly, and then the market goes crazy like COVID again. And they're printing trillions of dollars every 90 days. That's unsustainable. It's very dangerous, not so much for us, but like for our kids, a country being so far in debt. What if that debt gets called at some point, right? That's a real thing. And it's something that we need to be, it's our fiduciary responsibility, right? For the next generation to make that a topic that we talk about. So overall, great that rates are getting cut. I wanted to go faster, right? I wish they would get cut faster, but I understand why not. So it's really somebody's got to make that call. And that's why we hire. I say hire, people say elect, but we hire somebody every 4 years, right? Somebody campaigns for it, they ask for our business, and we give them that opportunity to represent us. I think they're doing a good job. I'm scared for them to reduce rates too quick, too. As a broker, I make a bunch of money because guys like Bio, they're ready to deploy capital as soon as those rates go down and buy deals, and I would make a commission. Or as a buyer, I would get excited. As a seller, I get excited. But once we get back in that loop of just rapid fire buying deals that don't even pencil because you can just sell it later on to another buyer, it's scary, man. It's real scary where things can get if we don't get that under control.
Yeah. Currently, I feel like there's a little bit of a disconnect between the market sentiment and the actual fundamentals. So, what do you feel about that in terms of fundamentals? Because I know the major issue before was we're getting better pricing now, but just what are you saying as a commercial broker? Like, for example, I'm trying to get more personal properties in Tulsa, for example, and then it will be priced like sometimes almost double still. I'm like, why do you think you're gonna get 120 per unit? And it's priced right beside mine that I bought 45 a unit or something. It's
Yeah.
ridiculous.
Yeah.
I don't know what people are saying. People are pricing for the future, they're not being realistic.
Yeah, it's a lot to what you asked. A few things that I did want to touch on. We'll start off with, as a broker, what do I see in the market as far as like intrinsic value? And for those who don't understand what intrinsic value, it has like a Greek origination of like, what's the inside value? Does that make sense? Intrinsic, inside. So how does that relate to real estate? What's the inside value of this asset? Not just what can I sell it for, what can I trade it for, but what's the real value of it to me? And that's why bios, man, this dude is pricing this property at 120 a door. I think when you're in this cycle of real estate, let's go back to cap rates. That's the one true valuation that's tried and true, right? Forget the sale comp because it doesn't matter right now. Like you say 120 a door, but is it a B class property? Are you comparing that to a C class property? Was that an A class? Right? What kind of property do you have? And based on like our basic education in real estate is like your cap rate going higher could just be higher because of the class of property, right? You're in C class, you're going to fit in a certain range in the market, right? In Tulsa, Oklahoma, a C class should be probably 8% cap rate, right? Like I want to make an 8% return if I'm buying a C class property. Is that unfair to ask? But in the past years, it's made it norm to talk about price per door, talk about what's my pro forma cap rate. No, we need to buy the true cap rate today. So, since that's the case, every person who owns real estate is not going to be a great seller. Some guys are better buyers than they are sellers. Does that make sense? So, like, I would say Bio is a great seller. He understands that, hey, if I've committed to sell, I'm going to price it accordingly to sell. So, because I have something else planned out. So, if I can get my equity out that I feel like is fair, I'm going to roll into the next deal. There's some guys that are sellers and they are the worst sellers. They're not even talking about cap rate. They don't have their financials in order. They can't tell you what CapEx they put into the property, but the intrinsic value to that property to them is so high. They love this property so much that they are terrible sellers. Depending on the situation of the person or the group is going to determine how they look at the intrinsic value. But what's the inside value of a property? You got to look at that as the buyer too, right? I would interview a seller and just ask him, like, what's the opportunity here? I know we got all these ideas, but ask for a call with the seller. If you had money and time with this deal, what would you do to it? Ask the brokers, ask the PMs. Try to figure out a different perspective than what you're looking at it from as an outsider, and really try to nail down that intrinsic value. Like, I look at every multifamily property or commercial property as almost like a mini merger and acquisition, a mini M&A. And like on M&A deals, like the true ones, like you got investment banks involved, you have bankers, you've got, the management group, you got all these different groups analyzing the deal and really looking at, they're trying to figure out what the intrinsic value is. What can we do to add value on this deal, right? Because our debt on it is probably going to increase higher than the last guy. So our expenses are going to be higher. So how do we figure out a way to add value on top of that knocks it out the park so we can cash flow and eventually sell at a profit? So if you look at it from that perspective, hey, I got to buy this business and I've got to add value to it somehow. You got to figure out what the intrinsic value is. What's that thing that's not unlocked yet? All right. It's probably not going to be the same thing that they're doing. But if you can unlock that key or unlock that lock that's been shackled for a while and open it up, there's probably some value that nobody else saw that you found. So those are the deals you need to look for if you can.
Talking about valuations, we know now we're in this higher interest rate environment since the last 3 years or so. And some of these deals have faced a lot of stress on the capital stack, just higher debt services because they used the floating rate product when rates were low. And then, of course, that got blown out. And some of them are stressed to the point where they have to sell or give the keys back to the bank. I'm getting a sense of there are some of these properties available, but there's this kind of, I guess, banks are doing loan workouts and extensions. So I'm curious what you're seeing. Are there actually properties that are getting foreclosed, having huge discounts on their valuations, or are a lot of banks doing these extensions where they're just like kicking the can down the road? Where's the shift? What's happening with a lot of these properties?
That's a
What are
good
you
question.
seeing?
So I think George, what you just described is fact, right? So we don't even have to talk about fact. That is happening. But I guess the question that I ask after that, because I try not to dispute facts, right? We know people are foreclosing. You guys bought a deal in San Antonio that was a huge discount. And I read the story on that. And that's what everybody has been talking about on podcasts for 2 years, right?
Yeah.
Eventually it was going to happen. And then y'all found that opportunity. And the intrinsic value was, hey, this guy's going to have to sell it to us for a discount. So we can come in with lower debt than we otherwise would have. Our basis is better. And it
They
gives
were happy to just pay the bank back. And that was
yeah. And then it gives you more room to operate and make a profit, right? So if you can find those opportunities, absolutely. I say yes, go find them. The problem is you guys got to know that there are a lot of physicians, a lot of professionals that have daytime gigs and they are rock stars at what they do. They own their own business, whatever the case may be. Like, you never want to shun people for making a way, right? What you guys do, you full-time guys that work your job full-time and create value outside of real estate, like, our country would literally stop and be in poverty if you guys didn't do that. Shout out to you guys, right? But the opposite of that is there's full-time, full staff investment firms that have junior guys just banging the phones all day. They know you can look, like, I have certain software as a broker. Forget like a high level investment firm. I'm just a normal guy with 500 units. I'm not that cool. I got dudes in overalls and straw hats that got 500 units, right? I'm not doing anything special. But as a broker in a Western Arkansas city, I can see how much debt is on every property that I look up. If I have software where I can click on a property that I'm interested in, I can see the owner's phone number. I can see the loan they have on it, when the loan originated, who's the debt holder. Some of it will tell you the interest rate, right? Those investment firms are calling those deals first. All right, you were originated in 2020. You probably had a 5-year floater. I'm hitting you up now. I know your interest rate's probably high. You're stressed. I see that you got 12 units advertised on your website. So I know you're probably at least 80% occupied, right? They got all this information, right? That's who we're up against to buy the 100-unit deal in Tulsa. That group who has all these resources. So to find that underlying deal like that at a really high level is hard, man. You got to really get linked up with guys like Bio and George are trying to help you guys do, right? Get together in a group so your resources can go a little bit farther. Get with somebody who is a full-time operator, who is operating at that level and can compete for the best deals in the market. Otherwise, right, if you invest your own dollars, you're going to hunt your own deal. I'm not saying you're picking up scraps, but you're taking something that's a little bit less attractive and not the deal that George is talking about. Does that make sense? George is talking about the institutional group that raised millions of dollars, got great, probably got a bad loan on it, got a bridge loan, but everybody was doing bridge loans. That was the norm. Nobody should be shunned for having high interest rate debt or floating debt because that was the norm, right? So for somebody to get caught with their pants down and then you point at them and say how stupid they were, everybody was doing it, right? So we don't want to do that, right? But yeah, that you just it's high competition for the deals that George described, right? Those deals on the floating rate debt or like the deal that's assumable, right? They're stuck in this long, they got a Fannie Freddie loan with low interest, but the investors still want out, right? And they got 5 years left, interest only, but like the investors want to move it. They want their capital back, right? So you're gonna go sell a deal with great debt. You probably got a good basis on it, but you can't maximize your value. And because all the investors want you to sell, you got to figure out what to do. Do I stand up to them and say, hey, look, this is great debt. I know we signed on for 5 years, but it's year 7 and it's not the time to sell. So we just got to hang on, right? Let's weather the storm. We got a great product. We're good, right? It's twofold, man. You could be in a bad loan and you could be in a good loan and still have that pressure to sell. And it's just not the right time to have to sell. It's still okay to sell, but you don't want to have to sell right now.
Yeah, I'm in a deal like that. We bought right, fixed rate. It's operating well. It's fully occupied, but we really can't refi or sell just because the cap rates have expanded. So you're not going to get that valuation that you wanted. You're not going to get that exit that you wanted. And that's something I've had to learn over this little stretch is there's factors that you just can't control. No one could have controlled how fast the Fed raised those rates. You can do everything right, but yeah, there's some things that are just out of your control. And that's a great point. Like cap rates expands, valuations go down. The next buyer has to make that pencil. And in order to make it pencil and cash flow, they're gonna have to pay a lower price. They can't pay that high price. So
It's what it is, man. And I'm doing a lot of underwriting right now. But the rest of December, I've really been spending time speed reading books, man, highlighting, making a lot of notes. I read 2 books last week. I've already ran through one this week, and it's Wednesday. And I'm underwriting deals, right? I'm underwriting old deals too, like deals that people sent me early in the year that I know didn't sell. And even ones that did sell, I'm going back to refresh my underwriting. All right, cool. They came in 300,000 more than I thought it was worth. Let me just play with the assumptions to see what they assumed is going to happen in the future. Because when you underwrite a deal, I learned this from one of our group members, and I never heard it before. And it's probably a term you guys heard, but I never heard it. Garbage in, garbage out. You put garbage data in, you can get garbage out, right? And it just stuck with me. It was so simple and plain. And when people underwrite, they put garbage in, bro. They say the rents are going to go up $400 and they're only going to put 4,000 into the units. 4,000 is just floors and paint. That's literally it. You can't even get stainless steel appliances. So your assumption is you're going to put a little bit of money in and the rents are going to go out of control. All right. That's one assumption. You got to test that. You got to go out there and prove it. You got to go to the property managers, do your own rental comp survey, and you come back to me without seeing mine and see if it's right. Talk to other operators. Just cold call properties. Hey, what's your rates? What can I get in for? Whatever assumptions you're making in your underwriting, you got to go out there and prove it. You got to go out there and prove it. And I think a lot of guys are just throwing stuff into a spreadsheet, getting their cash on cash return, and they're just like, all right, cool, let's do the deal. And it's like, bro, you're gonna have a rough few years, bro. Like you got to do a little bit more diligence than that. I think it's important for guys to really take their time on their underwriting, figure out what the assumptions are that people are making, even if you don't get the deal, still underwrite it, right? Figure out what assumptions they're making. And if you would have made that assumption and you would have made that same bet that they made, then the next deal do it. But I think it just takes that time and attention. And I get that from experience too, right? I've underwrote some deals and I looked back at it later and I'm like, man, I'm happy I didn't get that deal because I messed up. That wasn't right. And there's been times where I was too conservative and I'm like, dang, I'm renting these units $200 higher than I thought I could. This is awesome, right? So just take your time and really look at your assumptions. And during the investment, if you get the deal, you should be constantly checking those assumptions that you made to see if you're on track. And when you don't get the deal, still go through that process of figuring out if somebody you feel like paid too much, go through the underwriting, figure out what they assume. Get the same numbers they got because people want 15% IRR, right? They want 8% cash on cash. They want to double their money when they go out. Literally play with all your assumptions until you get to the point where it shows that. And ask yourself, would I buy this deal? Would I assume the same stuff they assume? And if you can't, and they made a big mistake, pat them on the back, say good luck, because you don't want anybody to fail, right? People lose their lives when people bankrupt on a deal. Oh, it may have been a year ago now, but there was a guy in California, super successful. He was on a big podcast, and I think the episode just released, and just out of happenstance, he committed suicide. Super successful dude. He's making millions of dollars and he loses his life because he's freaking out about how bad he's doing on a specific deal. And it's just going to be the end of me, bro. And he takes his life. So we don't want to see anybody go bankrupt, right? Like you have to be able to make profit off other people's pain. I think John D. Rockefeller said that. But you never want to see anybody else in this space lose. So I don't want people just out there looking and hoping people lose. I just feel like that's the bad energy to put out. But at the same time, be ready when guys make mistakes. Don't try to bash them and man, I'll operate this deal better, way better than this idiot. Because when you go through these underwriting exercises, you realize they just made a couple of assumptions that was the end of them. But you could have made that mistake too.
The thing is to grow and improve over time. But I do get it though. Yes, the floating rate. But immediately when people figure it was not working, some still, for example, funds. I've had a few people with funds, and they're in this situation where they have the capital already pledged, and they feel like they have to do it. They feel like they have to continue to do deals. There are sometimes you have to just put pencil down. Not, I guess, not really pencil down, but continue to underwrite, right? We always underwriting almost every few days. For the whole year, we only did one deal. You know what I mean? So you don't have to. But what happened is some funds feel like they have to continuously, and I feel like that's a bad mindset to have.
Yeah, but it's all, I want us to definitely take some pressure off of operators today because we all have to make decisions, right? Like we, as operators, you sit in the seat where you have a following, you have people who trust you. And Bio is basically saying, don't put everybody at risk because of your greed. I feel like that's what he's saying. Am I right?
Yeah, absolutely. There are sometimes you just have to relax. Also, if a good deal comes at any time, you should
Mm,
do it. You know what I mean?
yeah.
Very great deal.
So the reason I want people to take a little bit of pressure off of
Like,
operators,
yeah,
I want people to think back to we are just buying businesses. So I study a lot of business operators from the past. So J. Paul Getty, How to Get Rich, I read his book. He talked about numerous situations where the stock price is in the dumps, right? And he'll go buy 2 million shares of a business. And he's beckoning his partners. He's every business that I'm in, hey, let's go buy shares over here. I know everything's in the dump, but let's go do this. And at the time, everybody's looking at him like, dude, you are insane. Like, you need to take your foot off the gas just for a minute, bro. Let the smoke clear so we can get a full picture. When he makes those type of decisions, he's looking at the intrinsic value, right? So the decision that can also crush him. You go and buy $2 million, 2 million shares in a business, like you taking a big position, right? You coming to take control over a business in the Great Depression. That's crazy. But these guys understand intrinsic value. They study hard. They got information that the everyday person doesn't have, right? So they're able to make decisions that seem crazy to us to be deploying massive amounts of capital in a high interest rate environment. But when they have that data, they sit with that data, they meditate on that data, they ask questions, right? Reading this book, Brad Jacobs, he's built 8 different billion-dollar businesses since 1979. His first business that he started was a billion-dollar business. He was like 24 years old. Dude, these guys, they have information that we don't have. So if we can just study, get the information and sit with it and not always attack like Bio is saying. If you don't really know, don't go after it. But if you have a conviction, you've studied, you've asked around, right? You've done surveys, you've sat down with other people, right? You're studying a specific asset. Some of these guys I have 5 properties in Fort Smith that I would buy if it was for sale tomorrow. And I just continually reach out to these people. I don't care what environment it is, I would buy that property, right? I'm always studying up on these properties. I'm always keeping track of it. So if the deal comes about tomorrow, and let's say Jerome Powell went up, he reversed course. He went up 50 basis points instead of down 25 basis points. I would still buy that deal tomorrow because I know about that specific asset. That's the one, right? Like I've been studying. So I think if you're not studying, it's hard to make informed decisions. It's probably going to just be emotional. But if you're in the market, you're studying, but I think you take your chances if you feel that conviction.
Yeah. If you guys have questions, ask it in this chat.
And we have a Q&A.
Olufunso
as
raise
well.
a hand. Okay, let me press to answer then. Allowed to talk. Okay. Go ahead.
All right. How you guys doing?
Doing good.
All right, Joshua, I got a question for you. When you say you're studying assets and you're looking at a property that you've been studying and you know that if they ever try to sell, that's your cue because you've been keeping yourself up. How do you get that information? Because one, it's not your property. Two, who is giving you that? Who are you? Are you talking to the property manager? Are you talking to the owner? How do you get that information to be able to know what state, at what level in the game this person is, so that when you do get that person says, I want to sell, you are not just going through your underwriting trying to say, I want to get all this information out?
Yeah, that's a good question. So obviously, some information is proprietary. You're not going to get it unless you have the opportunity to buy the asset. The seller's giving you an opportunity. But you'll stick around in the market long enough where, and George and Adebayo have been here as well as myself. We've been in the market long enough to where we've made offers on properties and we didn't get it. And that property has gone through a full cycle. I've been around, I got a property that I'm thinking about right now. In 2017, I was a brand new real estate agent. And for whatever reason, one of the owners of this property says, hey, we're going to fall out of contract. I need you to find me a buyer tomorrow. And I found him a buyer the next day to buy the asset. And the original group still went through with the deal. And they still own it to this day. That was 2017. They did a refi in 2019. I checked in 2020, maybe 3. We took a look. I actually bought one of their properties in 2023, the owner of the property. So we start to build a relationship there. And I've checked in with them since 2023, since I bought this property. Hey, send me financials if you're interested in the offer or whatever the case may be. Check the website. I've seen that they've raised rents from about 700 when I saw the property in 2017. Their average rent is about, 900, 890 now. So they've gone up about $170 in rent over the past however long. So for me, I know that rents have gone up more than 20% in 8 years, right? Wouldn't y'all agree? Florida went up 20% in 1 year. That's how crazy it got in Texas, where these Georgia bio were buying. They went on a little buying spree in Texas. I know George is a Texas boy, so he got into some action and he saw rents go up 20, 30, 40% at times. So for them to go up 20% in 8 years, they're probably lagging behind market. I know when I get into my underwriting, I'm gonna shock a lot of those residents when I come in with a $300 bump, right? And I get this information from their website. If the guy will send me any information on the deal, I'll keep that. I've been around in a couple cycles now, so I've seen deals sell two, three times, and then I get an opportunity to buy it at a good value.
Oh, Olu, I'm curious if you're also referring to like how to establish like a relationship, get a phone number like specifically to call. Is that what your question is?
Yes.
Who, because obviously for Josh, it's going to look different than for you as a professional in medicine, and he's a professional in that field. I think it comes with time as well. You still, the more time you spend, the more relationships you develop. But just starting out, I maybe Josh or Bio can answer, give some tips on that. If you're just starting out, how do you make the inroads to even
Yeah.
be a repeat caller just to check up on the status? I think that's what
Yeah.
he was trying to get at.
Well, I'll tell you mine. Mine is to hook up with someone like Josh. So basically, you need a commercial broker, or not a broker, like even just a real estate agent that is knowledgeable. It's better if you find someone who's actually commercial. Josh and I make fun of that once in a while when people be like, oh, I'm residential, then I'm also commercial. It's almost like being a cardiologist and a pulmonologist. Sometimes you just have to go for someone that specializes in that particular asset class. So find a commercial broker and build a relationship, partner with them. Also, it's another way that I found. In my portal, my property manager is also a real estate agent. Done. So in that way, he knows what he's transacting. And sometimes be like, oh, I got a guy from California who is not managing it properly and really is trying to get out of it. Do you want to buy it? And then I'll buy it, he'll sell it, and then he'll manage it. So sometimes just building those relationships. So you just have to find few commercial agents. I
Yeah.
think that's probably more efficient for your time than you yourself going and try to learn how to do it and go do it. But I'll let Josh, if you got some tips.
I love that bio. Bio is he's you could tell he's well trained. Like he just goes to the professionals, tax people, accountants, whoever. He's gonna rely on that professional in whatever industry to make sure he keeps his time at top of mind. I remember in 2017, all the way through like 2020, mom and pop still manage properties. They put out their red sign and you can just call it the for rent signs. My first property I ever bought was a fourplex for $120,000 and the rents were $450 a unit, all one bedroom. I found the seller on Craigslist. I put no money down on that property, bank financed at 4%. I refied like 50 grand out of it a year and a half later, and then end up selling it for 250 a year after I refied it. And I found a deal on Craigslist. But that was 2018, man. Times have changed. The space is more sophisticated. A lot of the legacy owners have traded out of those properties because values went up. It was a good time for them to exit. Now we've been through COVID and now this downturn. Maybe on the next cycle, the next time the market goes up and then goes back down again, you'll still see some mom and pops owning properties and because they're the ones that's buying right now. Like families, just single investors. You don't see a lot of groups active because they have to deliver a return, right? They have to deliver a specific IRR, a specific time frame. Man, I know families that are swallowing up properties, man, buying 50 units here, 40 units there. So maybe you can start calling some properties soon and just get on Zillow, get on Facebook Marketplace, just kind of see who's managing these properties. Maybe you run into an owner, but if you don't have time, like Bio said, you really got to rely on brokers and things of that nature because the multifamily space has got more sophisticated over the past 5 to 7 years. A lot of groups got in when it was good and swallowed up properties and took them down and did some good stuff. And that kind of spread. So you don't have a lot of mom and pops just sticking bandit signs out saying for rent, call me like it used to be.
Where would it be a good recommendation to find brokers then for someone
Yeah,
like a doctor?
for sure. I would start with if you're going to go for the larger property that's listed by a big commercial firm, I would probably look towards the bottom of the list of people listed on the brochure. You usually will have the market director, the senior vice president, all the top level people who are super busy and have their client base already. You're going to see some junior guy at the bottom that gets no phone calls and they get like all the hard to do, time extensive things to do, right? Like prospecting, just randomly calling people. That's what you'll have your junior guys doing. They get a small salary and they get a small piece of the pie when a property sells. Call that guy and tell him, I'm going to be the best client that you have, and we're going to do a deal together. But I need you to find me some really good deals with these specifics. And that dude will go to bat for you because they have to feed their families. And I used to be that guy with a duplex, a fourplex, and somebody would call me and say, hey, I'm not interested in this. But if you find me this deal, I will buy all of them that you bring to me, whether that's a whatever the deal may be. And dude, I used to hustle for those guys because I really wanted to do better in life. So try to build a relationship from the bottom, help that guy get to where they want to be. The senior vice president or the market director that's on the top and they're connected, they're looking for the institutional, they're looking for the home run, right? They're not looking for the guy who just wants to buy a 12 or a 24 unit, $2-3 million, and to split 25 grand with 6 people isn't exciting to them. But if you call that junior guy and he brought the lead, you've got an ally that'll go to bat for you. And I think that's an overlooked opportunity that a lot of guys don't take into account.
Good. Do you recommend them buying the Craigslist or some software like to list source, or what's that one that we use to find the name of every property owner?
You got CoStar, you got,
List source or something like that.
yeah, I know what you mean.
Yeah. Yeah, or Costa. Costa is expensive though. But I'm just saying, should they go for something like that? Oh,
Probably not. I think that if you're looking for deals for yourself and your family trust, I don't think you should really be looking at deals outside of your market. I don't believe that. So if you are located in Arkansas and you're looking at deals in Cleveland, Ohio, dude, there's some stuff intrinsically in that market that you don't understand, right? You can't just drive, like Bio can drive to Tulsa an hour and a half and spend the whole day at his property. He can bring his family, he can kick it, and then still make it at home before dark. If you can't do that, you probably shouldn't be buying deals outside of your market. So I would start there, right? Look at just drive deals in your market in person and on blocks and neighborhoods that you like, right? Residents that rent, they have the same desires that we have to have a better life for them, their children, quality of life, good schools, proximity to things to do. So if you drive those areas and you like it, they residents probably like it too. Take those properties down. Look at the 12 unit over there. If you see a big 150 unit that gets you excited and that's the type of deal on LinkedIn and you like it, maybe go a couple blocks away from that and find the 12 unit or the fourplex. You'll find some people who still manage those properties. Call them. Or you may run into a really cool property manager that can give you some insight. Or you might run into a broker with a for sale sign out there, right? There's maybe residential, but they got a fourplex listed. I think it's still a lot of opportunities to find really good deals out there. But you gotta have the brain of just somebody willing to hunt for those opportunities. Like I said, those private equity firms do, right? They got all this infrastructure. But the essence of it is, hey, we got to find a really good deal, and then we got to market that to our investors, and then we got to deploy capital, right? For you, it's the same thing. Like you got to find a really good deal. That's what everything starts with. So you got to get good at that.
Switch gears to the demand side, like in the state of the market with just the state of the economy, the stress that we're seeing in job losses, and how do you see that kind of going into 2026? Also throw in there the state of the single family house market and where that's going because that affects the demand side on apartment buildings, right? Whether people are buying homes and moving into homes or if they are priced out of the market and have to rent apartments. What's the state of the market with that? What are you seeing? What are you projecting for next year?
Yeah, that's a really good question. And something that it's taken me a while to get to this point, George, just to say this very simple statement. I don't know anything about jobs right now. I look at trends just like everybody else. I have no projections about the job market. I have no clue, man. I do empathize with people though. I love people. Even though I'm like introverted, I really love people and I don't want anybody to really struggle on behalf of market factors. You know what I'm saying? That's got to be terrible to lose your job that you've dedicated your life to and that you probably love, man, because of market factors, because not even because of your performance. Like that's terrible. And then as far as the single family market, I don't follow it at all, man. I'm gonna be honest with you. So I've gotten to the point now I try not to speak on stuff that I don't I haven't studied on. But just from a people perspective, hang tight with your home, I think. Just if you got a single family house, hang on to it. Especially if you got it at a good value, you're in a good neighborhood, and you feel like the value's gonna go up long term. I think the 30-year mortgage is like the biggest trap to pay almost double for a property. Just because you got a low interest rate and long amortization, I think it's crazy. I think we should get back to paying our homes off. I'm not a Dave Ramsey guy either, right? This isn't like a school of thought for some kind of guru. I think just the fundamental factor of securing your home first. You know what I'm saying? Secure your situation. And who cares what interest rates are? If you got a decent interest rate, you should be accelerating payments, trying to pay that thing off anyway. Everything doesn't have to be an investment. You know what I'm saying? From a single family perspective. But as far as like the overall landscape of how single family affects multifamily, the single family market not being as hot actually helps multifamily investors. You get people who are qualified to own a home. They got high credit, 700 plus credit. They make good money. The squeeze of interest rates has priced them out of the type of homes that they want. And why buy a house that you don't want? The prices aren't that good. Just like multifamily, the prices haven't really shifted down to a point where you can buy a house and have instant equity. That's not really where we are. Tough for those people, but it is actually good for us as investors because you can get a B class property in a decent neighborhood, you can probably get the same rents as somebody in an A class neighborhood with the A class property or a B class property. It's not much of a difference from a renter perspective, from a B class to A class rent because these people can't buy homes right now. So you can push a little bit and get the higher rent. So it really, the common person is hurting. You notice the trend, like they can't buy a house. The rents are constantly rising on them. So they're not really getting the savings that they want. Like the middle class person is the one that's hurting the most right now in the country, in my opinion.
So, do you just to piggyback on that? I know, like we said, you always be buying, just like stock market. You just think about all the asset classes. If you love a particular property or asset, when the market is down, that's when you should even be looking at it even better, right? It's time to accumulate. When the market is high, time to start selling. But what do you think about the recovery? Because I do see some, like in Fort Smith for sure, I followed the permits. We're getting permits now, like for building new home, new houses, new. So I think last time I checked the permit was like a 630, but that was just on everything. And before last year was like almost like less than 100. So will you think all these newer properties is going to flood the market again? Because we believe that there was a little bit of 1.5 year or two where there's not a lot of permits,
Yeah.
and those are going to be finishing like maybe late next year or the year after.
Yeah.
They're going to flood the market. So, what do you think in terms of part of the state of the market?
I think that what we dealt with during COVID years was an anomaly in the sense that A-class properties were being delivered and the multifamily property that's 1990 built at that time was competing with the A-class property. You know what I'm saying? Because rental rates had increased and the new A-class property was coming online with the same rents as the B-class property built in 1991. And that was a problem, man. Like it was just a flood of housing. How we interpret the data that we get is very important. Just to know that we have a bunch of permits doesn't really tell you a whole lot. Because just because you have a permit doesn't mean it's going to get built. Just because you got a permit doesn't mean you get a loan. It doesn't really mean a whole lot. It just means you got a piece of paper from the city and it costs you a few $100s. You got a plan. This is what you want to do. Plans get altered all the time. I don't know the rate of permits that actually get built. I also don't know where these permits are concentrated. I just say all that to say all day, like every piece of data you get, you got to go a few layers below that. And until you do that homework and you sit with it and you study it, I really don't know how beneficial it is to the physician to know the deliverables and the permit rates and all that stuff. You know what I'm saying? Then you're getting too much in the weeds with something that has probably nothing to do with your investment. Study the numbers, study the data. And when big stuff happens in the market that you can't control, and you like permits isn't going to make you go bankrupt on a 12 unit, 630 permits. It's just not. It's some of this data is so high level that you need to go like 3 or 4 layers below that. Maybe find out how many permits and deliverables are scheduled to come within a mile of your property. That might be useful, but just in the whole city, probably not that much.
I use it mostly to show enthusiasm. So, for example, there was less enthusiasm for people to build. Like last year in Houston and San Antonio, it's almost like for multifamily, almost close to zero. It was totally down, like complete. So my take is that people are just bearish. That's just what it is. So if you're seeing more permits, people are either bullish, but the question are they bullish for the next 2 years, right? 3 years, like you said, it might take a while, or they might just get the permit and be ready and relax.
Yeah.
Wait on it for 5 years, but who knows? But I
Yeah.
feel like it shows, at least I'm excited about it in some way, that this real estate is people are coming back slowly.
Yeah.
But then the other part of it is eventually they're going to eventually build, or maybe not all of them, but
Yeah.
there's a big difference between 100 and 600. And even if you look at it at percentage wise, but yeah, it's also area dependent. Yes. So I think CoStar actually provides some of those data too that shows about how much is probably going to be delivered in the next around your property, like a mile, 2 miles, 5 miles.
Yeah.
And I mean,
I just think
that's,
I think it's really important right now for I think one thing you said earlier that's and I don't fault you for saying it because everybody says it. You should always be buying. I don't think you should always be buying. I don't believe that. I feel like you follow people like Benjamin Graham, who was Warren Buffett's mentor. He was probably sharper than Warren Buffett. He was ahead of Buffett, right? Like he was investing 30 years before Buffett even graduated college. But at the same time, like he eventually shut it off. Like he just wasn't taking chances like he used to. And Buffett was willing to take those chances. What Buffett did when he met Benjamin Graham was he would go to Geico, which Benjamin Graham was a board member and a main shareholder of. And Buffett showed up to Geico's headquarters from college, just got on the train, knocks on the door and says, "Hey, is there somebody who can tell me about this business? Just tell me about it." And now he's like a majority owner of Geico today. And that was 30 years before that happened. I think a lot of people need to take those type of principles and like just study right now. Like always be underwriting, always be learning, but you don't always be buying. That's stupid, right? This isn't like a sales job when you get in and get out. If you're always buying, you're literally signing your life on these loans, right? Like one of these deals that go bad can ruin your life if you're guaranteed. Don't just
yeah,
always be buying. You're like
yeah,
always
people
underwriting.
definitely should not be buying always. I definitely agree.
Yeah,
I
always
mean,
be underwriting, but don't
you should
always
be
be buying.
looking, and if you find a good opportunity, you should. Don't just be like, close your eyes completely
Yeah, no.
and be like, okay, market is bad. Let's just wait until 3 years. That's why many people will always miss the rally.
Yeah.
And usually it's not easy to come back. Many people know here from other asset classes too. You sell a stock and you be like, I'm coming back to buy it. You don't
Yeah.
buy it. You just wait another 5 years.
No, it's this one line that I thought was really good in this book. And I've been highlighting a little bit more so I can get to it pretty quick. He was basically saying, this is Brad Jacobs. I'm gonna find this page.
While he's doing that, if you have any questions, you guys can raise your hand so we can unmute you.
Here it is. So Brad Jacobs said we passed on abysmal deals as well as okay deals, but not great deals. They were okay, but not great. And sometimes that meant waiting when we would have preferred to be signing. The deals I avoided have contributed more to my success than the deals I've ever done.
Absolutely.
And that sounds so simple. One deal that's catastrophic that you were just being so aggressive and you just, man, I'm just gonna do this deal. The assumption isn't too aggressive, I can do it. You don't have any data to back it up. You got all the expenses going down over the next 5 years and all the income going up over the next 5 years. You're putting too many eggs in the basket of everything going down and expenses and everything going up. That's too much, that's too big of a risk, right? Like sometimes you just got to pass and know that the deal you passed on is going to save you from potentially being out of the game, right? And just waiting for that great deal that the assumptions aren't too aggressive. You have data to back it up, and you feel comfortable that the assumptions that you made, your team can achieve it, whether that's your property manager, you, or whoever your team is going to be.
Yep. You're gonna know when to fool them.
Yeah.
You listen to Kenny Rogers, right?
Yeah.
Know when to walk away. So, any more questions, guys? We have Charles, Faith. Let's see. Felix. Okay. Any more questions, George?
No, I think this was a good conversation. We're at the bottom of the hour, top of the hour. So I think we filled the hour with good conversation.
I actually like it. Yeah, just chatting, going over almost like a podcast style. Maybe we should do that more.
Yeah.
I appreciate it, guys. Thanks for the
I
opportunity.
got one last one. Sorry. I got one last. You guys talk about looking at your markets around you and if you can drive to it, if you can see it. And I'm doing that. I'm in North Carolina. And it seemed like about 100-mile radius of me is just what I consider to be a little bit on overpriced side. The numbers just don't work. But then I thought about it and I go, maybe it's just a market. You keep looking until you find the one that the numbers work. And I think because of that, I dabbled outside of the states to see if there were other markets, specifically Ohio, that I'm a little bit familiar with that, with Ohio, because I used to live in Ohio, whether that market works better. And when you just do rough numbers and you look at it, maybe it does, but then there's always
That risk.
that risk of you too far out and you're relying on
Other people's information.
yes, and with depending on what their motivations are, the information that you get might be slightly skewed. And how many times can I possibly go there and to get a feel for it? So I definitely know what. So I guess my question is, if your market doesn't work, do you just wait and find what works within your market, or when do you say actually your market does not work and you need to look at other markets?
That's a good question. I deal with a plethora of investors. It got to a point in 2020 to 2022 when I was doing about $50 million of volume a year, and I never went to a closing. I never met the people that were buying the properties. It was just a really weird time. And when it feels weird, you're probably right. The market's just too hot. Guys are just buying sight unseen. They're taking unnecessary risk. And that time period was just a time when I met so many people from so many parts of the country. Like, why are you so concerned about Western Arkansas? It didn't make any sense to me, and that should have been a sign. Easy. I
Yeah.
think you gotta take a page out of LeBron's book as you get more experience. And I feel like being in these rooms help you with your experience, listening to people who have deployed capital, who have done different things. Like none of us have said that we're buying properties several states over. Bio said he's trying to buy more properties in Tulsa, Oklahoma, which is an hour and a half away. He's not talking about, you went to school in New York, right, Bio? Or was it Boston? You're on mute.
I did my residency in New Jersey
New
and then
Jersey.
fellowship in
He's not
Pittsburgh.
buying real estate in New Jersey right now. George isn't buying real estate in other states. I'm from Rich, Virginia, born and raised. I went to school in Durham, North Carolina in high school. I lived in Illinois for a year. I've lived in Oklahoma. I've lived all over the country. I don't know anything about Richmond, Virginia today. And I spent 19 years of my life there. If I went back there right now, I wouldn't know where to look for multifamily.
Okay.
So just stick to where you're at. In my opinion, you just open your, like you said, like you talked enough to where you backed into it, man. Maybe I'm taking on unnecessary risk. And I think buying outside of your area is just, you could take the risk if you believe in it, but it's a risk that is very hard to navigate. Very hard.
Roger that.
Yeah. But thanks for the question, Olu. I appreciate it. I appreciate you being engaged too.
Thank you.
Yeah. Sometimes we know things and you just need other people to.
He said it.
It's like
He
we all
said
know we
it.
should diet and exercise, but you just want to help you a little bit to hold you accountable or just advise you.
Like, man, I don't feel like I don't know if I'm taking on unnecessary risk or
Yeah.
I like him, man. I like Olu. He gets it.
Yeah, I also believe that there's always a deal. It's a big place. You're just not finding that deal, in my opinion.
Just dig deeper by what I was saying. If you're not finding that deal, like you passing, like I said earlier, if somebody buys the deal that you said is a bad deal, underwrite it and figure out why. What assumptions did they make? And then you may say, all right, if they made that assumption, let me see if I can prove or disprove their assumption. Let's not just say it's a bad deal because of our underwriting practices today. You may learn something about your underwriting practices that may be a little outdated. You know what I mean? So like really dig deep, dig a little bit deeper, ask a little bit more questions and figure out why deals are still happening, like the ones that do cross the table.
Roger that.
Yeah.
Okay. So we're going to round up. It's great to meet familiar faces again and get back on these webinars. Thank you, Josh. We always banter a lot, go back and forth. And we like to be each other's kind of devil's advocate because that's how you do it. Somebody be like, okay, this is it. Then we try to be like, okay, you go against it. Convince me not to buy this property. And then you try to see if you can do it. And I think it's good practice to have few people. I know David, he calls me, I call him, everybody calls each other just to clarify a few things. David, I might ask you a little bit. He called me, man, I just did a inspection on this property and it doesn't really look that great, but it was such a great deal. And there were some foundation issues. And I'm like, just stop talking. After that,
FYI, I terminated it today.
Terminate this deal.
It was too much going on. Yeah.
He tried to convince me to buy it. And you try to convince me to buy your own deal. So I'm like, okay, so sometimes we just have to rub brains together. Feel free to rub brain with people in the group chat and things like that, just to see what you're trying to do. If you're questioning yourself and you really feel like you should walk away, but you're trying to convince yourself otherwise, in this environment, you should walk away. A few years ago, like Josh said, you could close your eyes, throw a dart, buy something, and you still walk away. Okay, scot-free. But now you're going to get punished. Anyway, so thanks everyone for coming. And then have a great day.
See you guys.
Thank you.
Okay.